Welcome back everyone, I hope you're doing well, and in this video, we're going to take a look at two dividend paying companies that I just bought in my financial freedom portfolio, which is now worth over $98,000. And with the market trading near all-time highs, it's getting harder and harder to find any good deals, and I believe most dividend paying companies are actually overvalued at their current share prices. So over the past week, I decided to add to two of my existing positions by the dip, as both companies have now fallen from their 52-week highs, and I believe they are trading at a reasonable valuation relative to the overall market. And for each of the two companies I just purchased, we're going to take a look at their current operations, the dividend info, and the future expected growth over the next few years, and I'm going to share with you how much of each company I own and how much annual passive income it provides me in my growing portfolio. And before we take a look at that first stock, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy and any major market news. So please hit that like button, subscribe for the daily videos. And the first company that I just added to my existing position over the past week is ticker VZ, which is Verizon. They trade for $57 per share, and over the past 12 months, they're pretty much flat, only down in the red by 0.5%. They have a market cap at $237 billion, a very low forward PE of only 11.26, and a nice high dividend yield of 4.4%. And after the market's recent rally, there's only a handful of companies that are offering a growing and sustainable dividend with a starting yield above 4%, like Verizon is doing at their current level. And we can see from their high point back in late 2020 of close to $62 per share, the company now trades down over 7%, so a slight pullback from their 52-week high. And according to Morningstar, Verizon is currently trading slightly below their estimated fair value per share of $58.36. So as we sit in a market that is extremely overvalued, I felt very comfortable deploying my capital into a company that is a blue chip dividend payer, projected to grow over the long term, very consistent revenue, and is sitting right around their estimated fair value, so I don't feel like I'm paying a very high premium to get into Verizon at this current level. And with a forward PE of only 11.2 and the overall market trading with a forward PE ratio of around 25, I like the value that Verizon is providing at this current level. And I'm not the only investor that has been heavily buying this company as of late, and Warren Buffett early on in 2021 has added Verizon into Berkshire's public portfolio with a stake worth close to $9 billion. And this company is now the sixth largest position in Buffett's massive public equity portfolio. And over the past week, Verizon has also just released their Q1 2021 results, and we can see they generated total revenue of $32.9 billion, which was up 4% year over year. Their adjusted EBITDA had a margin of 37% over the quarter, and their earnings per share came in at $1.31, which was up 4% over the prior year as well. And for a dividend paying company, we're concerned with their cash flows, because that quarterly dividend comes out to their investors in the form of cash. And we can see the company in the last quarter generated $9.7 billion of cash flow from operations, which was up $900 million over the 2020 number. And their capital expenditures came in at $4.5 billion, and the company's total free cash flow came in at $5.2 billion, which is incredibly impressive. And they paid out $2.6 billion worth of dividends over the past quarter, so right now, their free cash flow payout ratio is right around 50%. So after their capital expenditures, the company still has 50% of their free cash flow to reinvest back in the business, to expand their operations, and to pay down debt every single quarter, and that shows that their dividend is extremely sustainable at its current level. And if we take a look, they have a yield right around 4.4%, their annual payout is $2.51 per share, and their net income payout ratio is right around 49%, which is very safe and very sustainable. And they grow that payment, averaging around 2% annual appreciation, and at this current level, their dividend is considered very safe, coming in with an 87. So very unlikely that Verizon cuts that payment anytime soon, and they also have a very low beta of only 0.37, so not a lot of share price volatility when you own this passive income producer. And in my personal portfolio, I have a market value in the stock of $5,300. It makes up around 5.5% of my overall portfolio, and I own 94 shares. That provides me with $235 in annual passive income. So every single year, regardless if I do any work, Verizon will contribute $235 of income into my portfolio, which is incredibly impressive. And going forward, this is a position I feel I will continue to build over any dips we see over the next few weeks. And if we take a quick look at Verizon's financial statements, the company generates a massive amount of revenue every single year with just under $130 billion in the trailing 12 months. And we can see year over year, their total revenue is somewhat consistent, right around the $130 billion mark. And of course, stagnant revenue would usually be a red flag for me, but if we take a look at their cash flow statement, starting in 2017, the company's total free cash flow was at $7.4 billion. But then they grew that to 16.2 in 2018, then 16.9, and then in 2020, they had over $21.45 billion of total free cash flow. So although revenue has been somewhat flat over the past few years, their total free cash flow at the end of the day is continuing to grow at a very fast rate, and I feel very comfortable owning this company when they generate over $21+ billion of total free cash flow every single year. So I decided to add to my position. It is now the fourth largest holding in my portfolio. I may continue to buy more. I do believe in Verizon long term, and I think this is a blue chip dividend paying company that you can invest in. It's not very volatile, collect your growing passive income, and you never really have to worry about what Verizon is doing over the longer term. So like I mentioned at the start of the video, the two stocks I bought were very boring, very consistent players. And now if we take a look at that second company, it is ticker KMB, which is Kimberly-Clark. They trade for $132 per share. They're down close to 6% over the trailing 12 months, and the company has a market cap at $44.65 billion. So this is the consumer company, a very boring brand. They don't do anything spectacular, but they've been operational for over 150 years. They're trading with a forward PE of 17.5 and a nice dividend yield of 3.45%. And this is a company I just decided to buy the dip. It's one of the smaller positions in my portfolio. I only own 16 shares in total, even after my most recent purchase, and the stock is down close to 17% from its recent high. So I decided to buy the dip on a company that has been downtrending as of late, and they just reported a weak quarter, and that's why we see this major drop over the past few trading sessions. And now if we take a look at Kimberly-Clark's latest investor presentation, the company was founded back in 1872, and their products are currently being sold in 175 countries and territories all around the world. And right now, they own the number 1 or number 2 position in the consumer sector across 80 different countries, and they own $5 billion brands under the KMB umbrella. And what I find extremely impressive is that a quarter of the world's population uses KMB products every single month. And if we take a look, this company owns the major brands such as Huggies, Pull-Ups, Cottonelle, Kleenex, Scott's, and many more. And they continue to expand these markets with smaller brands that they own under the KMB umbrella to create greater diversification. And if we take a look, over 2019, their organic sales grew by 4%. Then in 2020, they grew by 6% overall. So for a major company that's very long-term, that sells boring products that are necessities to consumers, they continue to grow at a decent amount every single year. And like I mentioned, this is a smaller position. It's a very blue chip name that I kind of forget that I even own in my portfolio. So I'm not expecting any major or drastic increase in sales every single year. And if we take a look, they do generate some consistent cash flow of $3.7 billion of cash flow from operations in 2020 and $2.5 billion of total free cash flow over the past 12 months as well. And in total, over the past decade, they've generated just under $30 billion of cash flow from operations and $19 billion of total free cash flow over the past 10 years as well. And if we see, they are a nice dividend paying company, very close to becoming a dividend king with a current streak of 49 consecutive years. And over the past decade, they've been growing their dividend at a CAGR of 5% per year. And in total, they've been paying out a dividend for 87 years, which is incredibly impressive, and not many companies have achieved such a feat. And if we take a look at their current dividend, they have a yield of 3.45%. Their payout ratio is very manageable, only 60% of their total net income, and they've been growing it over the past 5 years, averaging 4% every single year like we saw. And we can see at this current level, they have a very safe dividend with a score of 88 and an extremely low beta of only 0.29. So another company similar to Verizon, I own this stock. It provides me with a nice 3.5% annual yield. The share price appreciation over the long term isn't drastic, but the company will go up, and their dividend is growing, slightly outpacing inflation every single year as well. And this is a brand, it's like I mentioned, one of the smaller positions in my overall portfolio, but I own it just to get some more diversification. KMB, along with Procter & Gamble, really gets me exposure to the two larger and more dominant consumer brands on the market that are in pretty much every single store all across North America. And when the company has fallen over 16% from its high, I thought now would be the great opportunity to buy a few more shares to KMB. And in total, I own 16 shares with a market value right around $2,100. And they provide me with $72 in annual passive income that will continue to grow for long into the future. So a boring company, nothing too exciting in this episode, but my two latest purchases in my portfolio were more shares of KMB and Verizon. My portfolio now is very close to $100,000, and I think over the next week or two, as I contribute more capital, and if the market continues to climb even higher, I will hit, for that first time, the $100,000 mark, which I'm really looking forward to seeing. And from there, the snowball effect will only continue. More dividends come in, more increases to those payments, more capital contributes to the portfolio, and very soon we will see some rapid growth over the next few years in the future. So going forward, I'm going to continue to buy blue chip dividend paying companies, try to find some deals in this high price market, and any stocks that I buy, I will update you on why I bought them, the reasons why I believe they're going to grow, and the dividend income that they will provide me. And now we're going to wrap up the video. I want to thank you for watching to the end. I am the Gen Z investor, and every single day we talk about the stock market. And of course, today we went over an update of my two purchases in my fast growing portfolio that I love to see continue to compound every single month. And hopefully over the long term, it will allow me to achieve true financial freedom where the passive dividend income can cover all of my monthly bills and I can become financially independent. So thank you for watching. Please hit that like button and subscribe to join the community, and I will see you in tomorrow's video.